Oh, we're back.
We are back. Money Mondays.
Oh, my
Apologies, everyone. We had to
gosh.
cancel for a few weeks because I was traveling outside the country.
Not acceptable. You're supposed to be working the whole time.
And we got it working. And of course, Facebook is down. So, the latest news, not only was our Money Mondays not here, but Facebook is not live. So, we are recording
So
this
when are we supposed to have it, typically?
every Monday, 3:30 Central.
Ish.
Ish.
3:30-ish. So, but we're happy to be back, excited to be back in the saddle again.
I totally agree.
What are we talking about today, man?
Talking about how to earn passive income from apartment buildings. So for those of you that want to learn how to build passive income, definitely stay tuned.
All right. So what is passive versus active? We're going to get into this real quick before we kind of get into some of the nuances of the process and what it is. But being a passive investor is essentially you're investing money into somebody else's project, and by definition, you're passively just sitting back and letting the other person do all the work, right? So for example,
Keep going, Ben.
on our deals, our investors are expected to, hopefully they watch our webinar and review the documents as they should, right? But they got to fill out a total of 4 pieces of paper, right? So that includes a couple signature pages, maybe a questionnaire. Ultimately, should take them a total of probably 30 minutes tops. They make a wire transfer, and then essentially that's all they're expected they have to do, right? They sit back, they get their distributions, maybe they ask a question or two, they get their K1s at the end of the year, and that's it.
Yeah.
Right? That's essentially
Passive
it.
is the word
It's
you're looking for.
Passive, right? So by definition, it's not meant to be a lot of hard work. Now, what do me and Ferris and our teams do is called active investing, right? We're going out, we're finding the deal, we're underwriting the deal, we're going after the deal, we're raising money for the deal, we're putting debt on the deal, we're managing the deal after the fact, and anything and everything in between.
Dealing with all the headaches, all the drama, these deals, all this stuff happens, right? And it's an active thing for us, right? We are spending our time, right, in return for working on it, right? The opposite of passive. And it's not that there's a right or wrong, people, right? I think people seem to fixate on that. It's ultimately about what are your goals, right? Where are you at in your journey, right, for whatever wealth you imagine? And what are the things that you can bring to the table, right? There are many of our investors who, they have their gigs, they're pretty much close to retirement, they want to make their money work for them. They don't want to really have to deal with any of the sausage making, so to speak. There are other people that are looking to transition into this as a full-time job, right? Even people that are very successful, they love real estate. We had dinner last week with a friend who very successful, does well, but he finds real estate really attractive, and he's looking at essentially transitioning off of his full-time job his own company that he has currently, and really focusing on real estate. And again, there's not a right or wrong, people. It's about what are you looking for, and which of these paths can kind of give you that result.
No, and to touch on something that Ferris said, right? You need to realize that where are you at in your life? What are your goals? How much time do you have to dedicate to it, right? We've had people straight up tell us, I don't want to do all the work that you guys do, right? I'm either close to retirement, I am retired, or just they're busy, right? Think of the doctor that works 60, 70, 80 hours a week. Guess what? That doctor is not going to be able to do what we do. We live and breathe this stuff every single day of the week, right? And so at the end of the day, if they're working 60, 70, 80 hours a week at their W-2, no way they're going to be able to do what we do as far as multifamily syndication. Now, that doesn't mean that maybe they don't have a one-off real estate investment, and of course, a lot of doctors do, right? But to really scale it to the point where we're at, it's going to be really, really tough, right? Not impossible, but very, very tough. Right. So we got some questions here that Ms. Shanna wrote up. What is the process for earning passive income from apartment buildings?
Yeah, so I'll go ahead and answer that. So if I'm a passive investor, right, whether I'm an engineer with a job, a doctor with my clinic, all that stuff, right, those people are busy. What is the process for them? Most of them, it's first about identifying sponsors that you like.
Yep.
And then reviewing the investment opportunity once there is one, right? For example, we're sponsors and we have opportunities every couple months, right? It depends on what, if we find a deal that makes sense. And then as a passive investor, right, once you're comfortable with that opportunity, what the business plan is, what the return profile looks like, right? Not every deal is a fit for everybody, right? And some people are looking for maximizing cash. Some people are looking to maximize cash flow. Those are two different things, right? And so again, getting comfortable with that deal, that plan, that sponsor, right? Then from there, you're completing some paperwork. Most notably, you're completing an investor questionnaire, you're signing the PPM, the company agreement, you're reviewing all those documents, hopefully with you and your attorney, right? And then, from then, you basically send over the paperwork, you fund your investment, and you sit back, right? That's really it, right? And then you review maybe monthly updates, right? We send out monthly updates. Not everybody does monthly. We do monthly.
And not everybody reviews them either.
Yeah, and then from that as well, right? Monitoring, sometimes those communications that come monthly are important. Hey, we're starting distributions. We need you to update your bank account information, right? But then really the only other thing that kind of comes top of mind is, getting ready for a K1 each year and incorporating that into your taxes, right?
Yep.
For our deals, we do give investors a K1. They are basically shareholders in an LLC that owns the property. It's not owned by the operator. It's owned by the new LLC, right? That is compliant with all the SEC rules and laws. And the investors therefore get what's called a K1, which is a tax document, kind of like a 1099. But obviously for partnerships, you're getting that K1. And that's where as an investor, you get your losses, right? You get those losses that basically, even though the deal made a distribution, it might be doing very well, right? Because of what we do in real estate, you can get those losses and take that and apply it toward your taxes. So,
and I think the one thing that you touched on that was pretty powerful too. As a passive investor, you still need to get out there and find the people that are actively looking at deals too, right?
Yep.
So, some people aren't comfortable networking. I get it, right? Maybe you could do some Google searching. I mean, we get leads from investors that find us online too, right? But that's typically probably going to be, the minority of people. Most people are going to get out there and they're going to network. They're going to go to events, right? Because if for no other reason, they're looking to meet people that are actively looking for deals, right? So as a passive investor, you got to realize if you want to invest in something, you've got to go out and find the people that have the deal flow, right? So that's a big part of it too. You're not always going to be able to do everything from behind your computer, is my point. So what are the advantages of passively investing in apartments? What are the risks, right? So I would say the risks being that you have limited control over the deal, right? Because you're essentially saying, I want this manager, which is what we are, right, to manage the deal on my behalf.
Yeah, with
right?
you and 50, 60,
the
100 other
passive
investors,
right? You've got managers versus members, right? Or LPs versus GPs, right? It's all kind of synonymous, right? So, at the end of the day, I'd say that's probably your biggest risk is you have lack of control over the deal, right? But let's be honest, right? Unless you own a single family or you own something outright, they're always going to be acquiescing some level of control, right? Even if you have your own 30-unit deal, right? But you have a property management company that's managing it, guess what? They've got a fair amount of control over your deal, right? They're the ones managing your cash coming in, cash going out, how well the deal's, going to ultimately be, upkeeped and, ultimately run. That's something that you got to realize, right? So that's a risk, right? I'd say the advantages is something we touched on earlier, right? You got to fill out 4 pieces of paperwork and make a wire transfer, and that's essentially all you got to do, right? So you're trading back your time for a good return, right? People are going to say, well, if I did it all on my own, then I could take, the lion's share of it, right? But at the end of the day, it's what is your time worth?
I'd say that wasn't very passive.
You're going to be putting a lot of your own time in. It's going to be taken away from your family or maybe your goals, or you want to travel, or you want to do this, whatever it might be, right? That's what you're giving up to get that little bit more back, right? So I would say that, at the end of the day, there's a lot of advantages to passively investing. But the biggest one is that you can let the other guys go out and do all the hard work, and at the end of the day, it is a lot of hard work, right? So, what are the typical passive income returns you can earn from apartment buildings?
Typical passive income returns. I mean, you're looking at distributions, right? That's the most common thing. We distribute monthly, right? That's typically the positive cash flow left over for investors to do, right? To me, that's really the only immediately passive, right? Now, there's other indirect things like we talked about, like you get basically distribution, depreciation, right? And getting those losses, applying those, that helps give you cash, give you, hypothetical cash, so to speak, right? And, really on an exit of a deal, right? Outside distributions, you're getting the pops, right? But in terms of just straight up passive income consistently, right? It's those distributions, you're getting a pop on the exit, and then, from there, you're getting your taxes. I mean, I don't know, is there anything else that you're aware of? I'm nothing, maybe a refi is maybe the only other one to add, right? Instead of on the exit, we do deals where you go in maybe a year 3 refinance, right? And you're pulling out more capital, giving that to investors.
And you got to realize on a refinance, right? There's always some misconceptions about it, right? It's a return of capital event. For the most part, some people don't do it that way. Some people do, right? Versus a return on capital event. So at the end of the day, right, you're just getting some of your money back, right? But so it's taxed differently, but that's less money in the deal, right? Which you can go and reinvest in another project.
Yep.
So, tons of typical ways that you can get passive investor returns. I'd say maybe, some of the returns on a cash basis, right? You're looking anywhere from 6 to, 8 to 10, right? Is probably what you're looking at, on a multifamily syndication deal right now. Right now, back in the day, 5-7 years ago, it was a little bit higher, right? But asset prices have gone up a little bit, right? So you're going to get more on the back end and less on the cash flow. But still, 6 to 10, with all the depreciation and all the tax benefits that go along with, getting a K1 and everything that you can do as far as depreciation goes on commercial real estate, extremely powerful, right? And that's why it's so popular, right? So I don't think we're live, or maybe we are. Who knows, right? So we're gonna do a little bit open Q&A.
Yeah, so I'm sure going to ask one, right, that people want to ask. Okay. And I kind of hinted at it earlier, which is ultimately, as a passive investor, what protects me, right? Yep. And maybe on that same vein, how are these deals structured?
Yeah. So, we touched on this a little bit about a K1, right? It's a partnership. So what we're doing as far as when we syndicate, right, is we are selling shares of an LLC, right? So it's a partnership LLC. Right, so say you put 50,000 in, I'm going to give you 50 shares of that LLC, right? As an owner of that partnership, you're going to get a K1, right? And you're going to get your pro rata, share of income and losses, right? Typically whenever you do depreciation, you do cost segregation, there's a paper loss involved, which can, if you're, considered a real estate professional, or in some cases, ultimately always, talk this over with your CPA, you could potentially get the benefit of offsetting some of your income because of it, right? But there's typically going to be a structure, call it 80-20 to 70-30, between what the managers and the members are going to own, right? Members being the lion's share of that versus the managers. And so everybody's going to kind of get their pro rata share of once again, the income and losses. What was the other question?
What protects the investor?
What protects the investor, right? Ultimately, you're a limited partner, right? So you're limited, your exposure is limited to the amount of money that you have in the deal, right? Now, no investment is risk-free. That's the reason that it's an investment, right? I wish that everything that we put money into was, 100% upside and no risk, but that's just not how the real world works, right? But say you put $100,000 in, the thing completely implodes, I don't know, something horrible happens, right? The whole thing burns to the ground, gets hit by a tornado, whatever it might be, right? The limit to your exposure is that 100K, right? So that's essentially, and on top of that, we mitigate risk in a myriad of other ways, right? We underwrite conservatively, we're investing in great submarkets, right? We're investing in the right assets, right, that have a lot of growth potential, right? We're also mitigating risk by having proper insurance on the deal, right? So say, for example, that tornado did take it out. Well, you probably wouldn't lose 100% of your investment because guess what? We're properly insured on all of our investments, right? So the insurance company would rebuild the property. Now, it might be a year or so before that happens, but it's going to happen, right? So, at the end of the day, there's mitigation of all these risks, but it's not risk-free.
Correct.
Right? So you always have to look at everything, and both me and Ferris invest passively as well. We're big proponents of look at the team and their track record first, look at the deal, look at the submarket, then look at the deal, right? A lot of people get fixated on just the deal itself and do I like this deal and everything else. Really, I'm a big proponent of a good operator can make a bad deal good, and a bad operator can make a good deal bad. Right, so you're really, to just throw a cliche out there, you're backing the jockey, not the horse. And so people need to realize that in itself can mitigate a lot of risk with somebody that knows all the traps that you have to run on these big multifamily syndication deals. Not to say that a newbie can't do a good job, they absolutely do. I did very, very well on my first one. Maybe I stumbled into it a little bit, but at the end of the day, there's going to be people that can weather these things a little bit more effectively once they've gone through all the traps and throughout their career. That mitigates risk too.
Absolutely.
So, what are we talking about? Oh my gosh, we got an October sale.
Multifamily Investor Network. For those of you who've never been out, definitely come out. It's a chance to come hang out with us. we do this. Basically, our big one is once a year here in Houston. It's in our backyard. It's coming up February 12th. Ben hadn't set that date in a while. He kind of forgot the exact date. So
it is February 12th.
It is February 12th.
You know? Well, I don't have these. I haven't had these for a while.
No,
Remind me every week.
If I don't remind Ben, to tie his shoes every morning, he's gonna forget. He's gonna forget.
It's crazy.
So February 12th coming on up. Use the coupon code OCT150. So October OCT 150.
All right.
So basically $150 off. Go ahead and book it. Prices will continue to go up.
Pretty good deal, man.
We should probably have 400 or 500 people.
We're making any money on this thing, Shanna? What's going on
here? We do not make any money on this event.
We're not making any money on this, but we like having a good time. We love networking, folks. This is the whole thesis of this event. That's why it's called Network Conference. Right? So you come out, you learn some stuff, but you're ultimately there to build relationships with other great operators, maybe passive investors, and the vendors that we use. We invite the people that we use out to these conferences. So, it's a good way to kind of learn and network, and we always have a good time. So yeah, check that out, www.mfinvestornetwork.com. Check out coupon code OCT150. Get yourself $150 off. I think we ran out of VIP tickets, right, Shanna? Not yet. We got a couple left. So if you want to check that out, give it a shot too. What is coming up next week, my friend?
Tips for navigating the closing process. If you want to learn what closing looks like, what that process looks like, the good, the bad, the ugly, check it out next week.
And we definitely run some traps on that, man.
We have, I like to say we are well-seasoned veterans of multifamily. The good, the bad, the ugly.
It's been crazy, but we've learned a lot.
And we're still here fighting, so that's the important thing.
Is important, but we've learned a lot.
You stole my word. You stole my word.
Hey. Well, I typically do that, right? I hear a good word, I'm just going to roll with it, right? Yeah. So we might have two parts of this. Because this is an important part, I think, of the process that people need to learn, right? Including if you're a passive investor. What are we going through? People just think that you get the deal under contract and then it just, miraculously closes, right? There's so many nuances to the process that people need to understand. Yeah. We might do a two-parter. Who knows?
We'll see.
We'll get crazy.
Ben loves the reasons to keep talking, so no problem. So
ouch,
we'll do a three-parter if we can. No, but as Ben said,
there's a lot
that goes into it. I left the ball joke out, but now
come on, it's not Money Monday.
I didn't want to give you a ball joke because I didn't want you to lose any more hair.
Oh well, that's that ship has sailed, my friend.
But Money Mondays. We do every Monday, 3:30 Central.
Yep.
Next week, we're talking about navigating closing process, so come check it out. And we'll see you guys then. If you guys have idea suggestions, please make those idea suggestions. Otherwise, we can keep, coming up with ideas ourselves. But, we're always happy to, and it doesn't have to be about multifamily specifically, right? We love talking about investing, what we know, and sharing some things we might not know, and we'll say we don't know. So go ahead and give us suggestions. But otherwise, we look forward to seeing you guys next Monday.
3:30-ish.
Thank you.